lender discharges the debt, you're going to have you may have the same thing we saw on the other side of the board there. You may have some ordinary debt cancellation income, and you may have some fair market value. Foreclosures get to be a little more interesting. What happens is that a foreclosure, again, you're going to have to talk with legal counsel to see what happens to the debt and when it happens in all of this. It's going to differ whether it is your primary residential property or whether it is an investment property, and a lot of it has to do with whether that debt is discharged, whether the underlying seconds are discharged or not. So watch the property transactions again. A foreclosure on non-recourse debt, what's going to happen if, in most of the cases we're looking at now, in many of them in fact, the debt is higher than the cost of the property. And if that's the case, there will be a loss. But if it's your primary residence, it's a non-deductible loss. So here again, we want to be very careful. If it were not for the, let's go back to the recourse debt. Okay. The owner, at the bottom bullet here, the owner is going to be treated as getting ordinary income. And what we have to be careful about with the recourse debt, there may be an exclusion under 108, but what we're going to find in a lot of cases, there's only a partial exclusion under 108. So again, come back, you're going to see the term fair market value sprinkled all through this thing. In foreclosure transactions, the bickering about fair market value is likely to be the most significant, because in a foreclosure, it's primarily going to be about, you don't have a sale per se that is going to drive that set of numbers. When you have a foreclosure, the gain or loss on the property transaction is going to follow, just for what it's worth, in the year when any kind of a redemption right or a recovery right lapses. So you may have the property being foreclosed and taken in 1 year. If there are redemption rights and some other issues, your tax event may come in a later year. Again, watch the 1099s. They may not follow that rule. One of the things about debt discharge is that where you report the debt income, the cancellation of debt income, or the gain or loss on property you give up, depends on the type of property. There are some of them that are totally non-deductible if they're losses. However, here's the bad part. If you have a gain, even though it's a personal use asset, it will be taxable income, either as miscellaneous income or a capital gain. If you have investment property, now there's one nice thing that this whole process does. If you had a gain on sale of rental property, you would have potentially long-term capital gain. You'd have a favorable tax rate. If you have a loss on a repossessed investment piece of rental property, though, it's an ordinary loss. It's not a capital loss. So there is some help for us there. Abandonments, in their own way, are rather interesting. And there again, watch for your clients what happens here. When a property is abandoned, and there are some technical rules about when property is abandoned, generally it's abandoned when the owner leaves it, abandons it, with no further intention of occupying it, using it, retaining it. What you're going to find is that that abandonment is a taxable disposition of the property. But unless you can go to Tammy, and unless Tammy can tell you that the debt has been discharged, what you have is a sale for zero. So if you had a house that cost you $150,000, and you bought, well, you paid $200, you paid $150 for a house, then you levered it up and you borrowed $200 against it. If that property is abandoned, you will get a 1099-A from the lender, who, once they come in and take it, and the 1099-A is going to tell you what the fair market value of the property was, the date they took it, and what the debt was on You have a loss. You sold it for zero. So you have a $150,000 loss. How good is life? Someday, and you don't know when, you will either have a deficiency judgment, and you will pay the difference, or you will have a cancellation of debt that will spring on you, and it will happen when that debt is discharged, but not until it's discharged. So you can have a loss in one year and income in another. So we want to just be aware that the timing of these can be a little out of sync. We get back to the fact, be careful as you work with your clients, and many of you have your own properties. If there's one line that I would want to leave here, there are potentially two separate transactions when properties go back, either in a short sale, in a foreclosure, or an abandonment, particularly in a foreclosure or a short sale. There is a gain or loss from a property transaction, and there's a debt discharge. They're generally separate events, and they're separately reported in separate taxable events. It is possible to plan it in such a way that you don't get stung, and you can at least help control the way that the income is reported. Okay, you're going to see that last bullet is an important one. On investment property, if you have gain, it's long-term capital gain. If that property is lost and gone, the property part of the transaction is an ordinary loss. It can generate a net operating loss that can be carried back now up to 5 years. It can be carried forward. It can be used to offset other ordinary income. Kind of fun. You could use it to make a Roth IRA conversion. How good is that? But your loss is always limited to your taxpayer's basis. And your basis, as you're aware, is what you paid for the property, plus any improvements that you made to the property, not your carrying costs. Hopefully you've been deducting those all along. And then the last piece to it is minus any depreciation that you will have claimed. Loss from your personal home or any other, if you put mom in a house out in the backwoods somewhere and you're not collecting rent, that's personal use property. The Mortgage Relief Act of 2007. Interesting act. It was extended in 2008. So these are for discharges generally from, I'm trying to make sure I know when that is, occurring after 2006 and before 2013. What's important is that if you have a client that uses this, or if anyone does use it, all of the, as we go, remember, Code Section 61, everything is taxable, including number 12, discharge of indebtedness. Section 108 says, however, we have absolution if certain things happen. And we'll go to the Section 108 a little more here in a moment. But if we use the insolvency issues, some of the debt offsetting basis issues, what happens is you're going to lose basis in other assets. Here's another thing that I'd like you to really do as a service for your clients. You need to. If you have a client who is going to be dealing with the debt discharge, either through mortgage debt relief or particularly through insolvency, we'll talk about it a little more, you need to help them evaluate all of their interest in real property, both before the discharge and after. Because the property basis, what they purchased and owned the property for, is going to change if they use these Section 108 types of exclusions. It's not what it was before, and they're going to need your help to get that done. Generally, what the code section, the Mortgage Debt Relief Act does is it says, if you have a discharge of indebtedness related to a principal, your primary residence, you can exclude up to $2 million on a joint return or $1 million otherwise.